Assalamualaikum warahmatullahi wabarakatuh. My name is Amirul. Today, I will be presenting MFRS 134, Interim Financial Reporting. An interim period is any reporting period shorter than a full financial year. Under this standard, company can choose to prepare either a complete set of statement or condensed set, which focuses on significant updates since the last annual report. Now, how often are these reports issued? It depends on regulatory requirement, and there are three common ways. First, semi-annually. This is the minimum frequency encouraged by the MASB as a mid-year check. Second, quarterly. This is mandated by Bursa Malaysia for all main and SCE market entities. Report must be submitted within 60 days after quarter ends. Lastly, bi-monthly. It's quite rare for public filing and mostly used for internal management in highly volatile industries. So, MFRS 134 ensures that financial data is relevant and timely for better decision making. Now, let's look at the significant event and transaction using a real-world example, Mr. DIY Group. We are looking at their rapid store expansion and capital expenditure. The group is pursuing an aggressive growth strategy, targeting over 190 new stores annually. This massive operational move must be disclosed in their interim report. How does this affect the balance sheet? First, new store leases significantly increase the PPE. Second, under MFRS 16, these leases are recognized as a right-of-use asset. Essentially, as they open more doors, their total asset base grew. What about income statement? Expansion drive up initial setup costs and depreciation expenses. However, these new locations are the primary engine for boosting total revenue growth. This shows how strategic decisions directly transform the financial figure. Now, let's move to the next part of our analysis. The second event is inventory and supply chain management. Mr. DIY makes large-scale procurement adjustment to prepare for peak festive season, like Hari Raya, ensuring constant stock availability. On the balance sheet, bulk purchasing leads to significant fluctuation in inventory. At the same time, buying on credit increase account payable. Essentially, current asset and liability will reflect these seasonal purchasing patterns. Regarding financial performance, freight costs and volume discount from bulk buying directly impact the gross profit margin. These details are vital for stakeholders to assess the company cost efficiency during the interim period. This event shows that financial statements are more than just numbers. They reflect strategic business moves.
Here, I'm gonna show you the interim financial report. On your left side is the statement of financial position, and on your right side is the statement of comprehensive income. Next, as you can see, it's the statement of changes in equity. And lastly is the statement of cash flow. I will be analyzing the interim financial report of Mr. DIY Group Malaysia Berhad, a public listed company on Bursa Malaysia. The group record revenue of RM1,240.2 million, a 1.5 year-on-year increase, driven mainly by contribution from new store. Gross profit grew 6.4 year-on-year to RM579.5 million, supported by higher revenue and improving gross profit margin, which rose by a significant 2.2 percentage point to 47.7%. The improvement margin was primarily due to lower average inventory costs following the strengthening of the Malaysian ringgit against the US dollar and the Chinese renminbi, a trend that continued through June 2024.
For Part B question 1, I will explain about definition of MFRS 8 operating segments. MFRS 8 was issued by MASB in 2009 and applies to companies with publicly traded securities or those providing segment information. It is used in full financial statements, and if both separate and consolidated reports exist, only the consolidated financial statements are used. The purpose of the standard is to guide how companies report their operating segments. It requires disclosure of information such as products, geographical areas, and major customers. This is important because it helps users understand the company's performance, assess risks and returns, and make better decisions. An operating segment is a part of a company that earns revenue or incurs expenses. It's reviewed by top management and has separate financial information. However, departments like the head office and research and development are not considered operating segments unless they generate income.
Next, I will explain about the Chief Operating Decision Maker or CODM. First, CODM does not refer to a specific person but rather a function within an organization. This function is responsible for making key decisions related to the company's operations. The CODM plays an important role in allocating resources to different operating segments. For example, deciding which department get more budget or manpower. Besides that, the CODM is also responsible for assessing and evaluating the performance of each operating segment. This helps the company understand which areas are performing well and which need improvement. It is important to note that the CODM can be different depending on the company structure. It can be the Chief Executive Officer, CEO, the Chief Operating Officer, COO, the Senior Management Team, or even the Board of Directors. The title itself is not important as long as the individual or group is performing the CODM functions. Now looking at some examples of Malaysia listed company. For Tenaga Nasional Berhad, the CODM is typically the CEO who reviews segments such as generation, transmission, and distributions. Next, for Mr. DIY Group and Berhad, the CODM is also the CEO who focuses on strategic decisions, resources, allocations, and evaluating retail performance. Lastly, the Nestle Malaysia Berhad. The CEO acts as the CODM, handling planning, resources, allocating, and performance evaluation across product segments. In summary, the main role of the CODM is to allocating resources, evaluate segment performance, and make strategy.
For question 3, there are two types of segmental reports. A business segment refers to a part of a company that earns revenue and incurs expenses from a specific type of product or service. It is based on what the company does, which is its activities. Each segment has different risks and returns, helps users understand which business areas perform well. A geographical segment refers to a part of company's operation based on location or region. It is based on where the company operates. Different regions may have different economic conditions, regulations, and customer demand. Help users see performance across different countries or areas. For the business segment of Tenaga Nasional Berhad (TNB), the main business activities of the company is generation electricity, transmission, distribution, and sales of the electricity. TNB does not present separate operating segments because all activities are highly integrated, treated as one single business segment, and consistent with internal reporting. For the geographical segment, the location of operations shows the performance in different countries. In TNB, operations are divided into Malaysia, United Kingdom, Kuwait, Republic of Ireland, Australia, and other countries. Referred to the statement, revenue by location shows that Malaysia is the main market because of the largest contribution. For the non-current assets by location, shows that the most assets are concentrated in Malaysia.
The first benefit is identification of main revenue drivers. Segmental reporting enables users to identify which segments contribute the most to the revenue and profitability. Without segmental reporting, users only see total figures and cannot determine which segment is the main contributor. For example, in Tenaga Nasional Berhad, the generation segment is a key contributor, while transmission and distribution provide stable income. Therefore, this enables users to identify key revenue sources and focus on the high-performance segments.
Second benefit is by providing detailed information for risk assessment and resources allocation across different parts of the business. Each segment operates in a different environment and faces different risks. For example, in Tenaga Nasional Berhad, the generation segment faces higher risks such as fuel price fluctuation and operational issues. Meanwhile, the distribution segment is more stable but subject to regulatory control. At the same time, segmental reporting also shows where the company earns most of the income. For TNB, the highest revenue earns from Malaysia. In 2025, Malaysia records approximately RM 66.4 billion, which is significantly higher than other countries. This is mainly because TNB core activities, generating, transmitting, and distributing electricity are concentrated in Malaysia. Overall, this information helps users understand risk, evaluate performance, and make more informed decisions.